Hey everybody, welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. Today my guest is Kevin Kerr, coming back to the program, who is with a senior analyst with moneyandmarkets.com. Kevin,
Mike, good
thanks
to see
very
you.
much for coming back.
Good to be here.
And I should mention to everyone that you, not too long ago, an American citizen, you left the United States. You now reside in Estonia, of
Right.
all places.
And
So-
that's not in Queens, Mike.
Okay, not in Queens, not that Estonia. But tell us how the world looks from where you sit now.
Well, Estonia is located right on the border of Russia. It's kind of on the fringe, I like to say, of the EU, and just recently took on the euro. I mean, they've been trying to get EU membership for a long time. They got that, and then they took the big step of taking on the euro.
Why in the world, with all the problems we see in the Eurozone, why would any country want to become a part of that?
Seems crazy, right?
It does.
I mean, they worked for so many years, Mike, to try to get this currency and be part of Europe, to be more part of Western Europe and, assimilate. And they really, they created their own austerity for a very long time. I mean, the people there have suffered high unemployment, just high taxes, all to get their finances in line to become a member of the EU. Why they wanted, I think, is just that belief that once they're part of Europe, supposedly, that there's going to be a lot of benefit. And so far, I've written about this. It's more like being invited to a wedding and it turns out to be a funeral.
Yeah,
it's that bad.
Absolutely, it is bad. Now you're a big currency and commodity guy. Are you surprised? And with Estonia's entrance into the EU, and with all the problems they're having, are you surprised at how resilient the euro has held up?
Well, absolutely. I mean, if you look at the systemic risk from Italy, Spain, Portugal, Ireland, the list goes on and on. Of course, in the Baltics, there's concerns everywhere. How is this currency managing to stay at the levels it's at? And I think there's a real warning here of what's to come. Spain and Italy are not Greece. If Italy's going, I think the euro goes. I think what we're going to see, though, ultimately, is maybe not the end of the euro, but a fracturing between the countries that have and the countries that don't have. It would be similar to if America and Mexico and Canada merged. When they split up, you're going to combine the weakest country, Mexico, and just have to split it up between the states here that are poor and rich. I mean, that's what's going to happen. You're going to have two-class euro is basically what's going to happen. Or it's not going to survive at all. It's really a mess.
Now, you're also a longtime commodity guy, and when you look at the environment now, especially given austerity, slowing economic growth, negative growth in some places, is it odd to you that we see a lot of buoyancy, a lot of strength in commodity prices given that backdrop?
Well, yeah, I mean, considering the state of the global economic condition, you would think that these commodities would be through the floor, especially oil, which is up close to 95 now again, and could go beyond that. And I think that's really reflective of the weakness of the currency, and the ongoing policy crushing the dollar, that the Fed is basically asleep at the switch. There's nothing else they can do. The dollar has gotten a little bit of a bounce because the euro's been decimated and probably will continue to be, but ultimately the commodities are benefiting from that weak dollar and
so
inflation.
It's not really a physical demand story as much as it is a portfolio shift type of event going on here.
Yeah, it's a risk-on trade in many cases, but what's scary is when we do see that global demand come back, which we hopefully will as jobs increase and the economy hopefully improves in who knows how long, that demand could be piled on top of this inflation and risk-on type of trade and really drive these prices up. And we could have the hyperinflation we've heard about, not maybe to the extremes that we've been told by some people, but certainly it could be there if it builds on this base of high prices we already have.
And what about, let's look at gold, which a lot of people view that as sort of another currency and a hedge against the type of money devaluation, if that's happening at all. But recently, we have seen a big pullback in gold prices. Gold still, on an inflation-adjusted basis, still below where it was in 1980. What are the prospects?
Well, I think that gold is reflecting the fear. I mean, this is a fearful market right now, and with good reason. I mean, for everything from major brokerage firms collapsing and trading sovereign debt to full-on countries going bankrupt and municipalities and whatever else is going on in this nightmare. So, investors have a reason to be fearful that their currency may be devalued, that interest rates are going to stay low for a protracted amount of time. And gold is reflecting that. However, I think there is some ceiling to gold here too, because we've seen a lot of investors who may not have that risk tolerance easily yank their money out, and we've seen gold really volatile, trading in ranges that we've never seen before, and all the commodities, in fact. So this is a very cautious market, but longer term, if this continues, I think you'll see certain commodities benefit significantly.
So investors should still be taking exposure to commodities, but have maybe a longer term time horizon.
Exactly. And I think the key word here is diversification. Sticking all your money into gold or sticking all your money into whatever it may be is never a good idea. Being diversified, having no more than maybe 10% of your overall portfolio in one sector, let alone one commodity, is probably the way to go. 10% is a good rule, though.
Do you see any policy changes? I know there's, we have Dodd-Frank now.
Didn't do much good with MF Global.
Right, exactly. And, MF Global, the most recent major firm to blow up, I guess a mini Lehman, but still sizable in its nature. Is this just going to be the nature of the markets now, or will we see some kind of real draconian clampdown on this type of activity?
Well, it's a tough question because I think that we have a lot of regulation in place. It's just not working. And the regulatory agencies, we have the SEC, the CFTC, the NFA, all these different regulatory bodies that have really not been up to the task.
Now, how much does that have to do with the financial sector and its influence on policymakers, the financial sector and its influence on Washington?
Not much. I mean, I think that personally, the self-regulating bodies do better than the government-run bodies. But, the Madoff case is a perfect example of how this fell through the cracks. Madoff walked right through, and meanwhile, small brokerage firms and other things would be crucified, looked at very closely that might not have been doing anything wrong. Something with the system is broken and needs to be repaired to serve the people, to protect themselves. What we've seen with MF Global is a perfect example of the worst kind of egregiousness by a firm, using customer funds to trade their own account. It's the cardinal rule of Wall Street not to do that. It's it's completely unethical and fraudulent. So investor confidence is key to these markets, to the proper functioning of them. And when that breaks down, the whole system breaks down. And this is largely what the Occupy Wall Street people are, in many different respects, saying. It's just not working anymore. And I think they have a right to say that. The message may be a little muddled in a lot of different subjects, but the bottom line is companies, banks, government leaders have all lost their moral compass and need to find it to get us back on track as a country.
Now, you talked a little bit about oil prices going up, and what about the geopolitical environment right now with, for example, Iran at the threshold of becoming a nuclear power? Is that going to inject a lot more instability into oil?
Yeah, I mean, all the change we've seen in the Middle East, Gaddafi running around and dying in some tunnel, and then we've got Egypt and Yemen, and the list goes on and on. There's been just an incredible change.
But now that Gaddafi's out, shouldn't that be bearish? I mean, could we not start to see an increase in Libyan output?
Yeah, it could take some time, and infrastructure is always a question. And who's going to be running the country now? Now they're saying about going full on into Sharia law, and who knows what you knew what was there before, and it wasn't so hot. But now we don't know what's going to be there, and that's even riskier. So we just can't tell yet how the oil is going to flow, if it's going to make a difference, and what the OPEC is, what they're going to do going forward. They're tired of the weak dollar. They know they've got a wasting asset or an asset that's diminishing, and so who knows? We'll just have to wait and see.
You spoke before about policies that are weakening the currencies and people moving into commodities. Look at quantitative easing, for example, and it's not a day goes by where we're not told, hey, maybe the next round of QE is around the corner. But QE did nothing for the real economy. It didn't help growth. Everybody piled into that trade. When QE was over, we saw a big collapse in commodity prices. Are investors chasing the wrong idea here?
Yeah, I think it is a little worn out idea. But on the other hand, when you look at the Fed, what else can they do? They print, and that's what they know how to do. They're not coming up with any real policy that's going to make a difference. So I guess, it didn't work. You're right. It's only a short-term trade, but it may be the only one investors have right now.
And look at stocks. I mean, haven't stocks held up fairly well in the face of maybe higher inflation and austerity policies that really contract growth?
Remarkably well, and not invested in the stock market or not invested in the commodities would have been much more painful than being, although the volatility remains extreme. So caution is the watchword.
And volatility has become like an asset class unto itself.
Yeah, I mean, if we look at the VIX on a daily basis, it's mind-boggling. And if you see some of the ranges in some of these commodities and equities, it's really troublesome.
All right, so for the next 6 months to a year, what is your best area?
I think things will remain volatile, Mike, and we're going to see what the Fed does and what happens with the elections. I mean, that's clearly going to weigh on this market this coming year. But I think, a longer-term long position in many of these things, equities and commodities, if you can weather the storm. So you have to use limited risk vehicles, whether it's options on ETFs or options on futures. Stay away from the heavy-duty risk stuff unless you can handle the swings. And just steer clear and keep the powder dry for another day.
Keep the powder dry. All right. Thank you very much, Kevin Kerr. That's it for now, folks. This is Mike Norman signing off. We'll see you next time. Bye-bye.